Now we're starting another one. A question came up about how we calculate break-evens. And the way we calculate break-evens for a, well, first let's start with the first building block is, okay, how do we calculate break-even on a call?
All right, guys, I'll be right back there.
So let's get the option matrix up here, and let's just I don't know, somebody come up with a nice stock that we want to look at. Just make it liquid, somewhat liquid. So we'll look at break-evens from a long call and a long put, and then we'll look at break-evens on long call spread, long put spread, credit put spread, credit call spread. All right, BA, good one. Been in the news a lot, very liquid. Okay, so for BA, and let's go out to regular June. Okay, so regular June, and I actually think I took the break evens off the spreadsheet, which I don't have to. I can put them back on there. But let's just say that we want to buy. Let's buy a slightly out of the money call. So let's look at like the June 360 call. Okay, June 360 calls trading for $7.30. So we know, and we can look at this graphically, we know that this is going to, let's push this out to June expiration, which is on the 15th, and then get rid of all these guys. We know that anywhere below the strike, we're going to just give away our premium. Once we get to the strike, we start to eat into that premium until we get to whatever the strike is plus the premium. And that's where it helps. You know, I know that you don't want to depend on the spreadsheet, but one thing that we can do is we can confirm what we think. So if we have the 360 call, and
if you can't, give me a couple bullet point reasons.
And I paid $7.40. So we know that at 360 or lower, we're just going to give away our premium. Why? Because this isn't worth anything. But once we start getting into the money, so if we get to 361, exact price of the call plus the strike even for break even, exactly. So once we get $1 in, well, now we have $1 of extrinsic premium that's good for us. We still have to pay our $7.40, so I lose $6.40 instead of $7.40. Like Brad said, to get to 367.40, well, now I make $7.40 on my calls that I'm long. I have to pay $7.40 to get into the position. That's where my break-even price is. Is that clear to everybody? That's the simplest example. And then we'll look at a put. Okay, if there's no questions on that, let's move over to the put side. Let's stick with BA. And instead of the 360 call, which is slightly out of money, let's do slightly out of money put, which would be, well, let's do the 355 put. 355 put is trading $6.75. Well, looking at this graphically, we know that anywhere above the strike, we're just going to give away our premium. As we get to the strike, then we start to, and we go lower, we start to make that premium back until we get to the strike price, or excuse me, the underlying price less the strike price less what I paid in premium. For example, these are trading $6.85. These are the 355 put. 355 put, I'm long one of these, and I had to pay, what did I say, 685? Let's just say 685. I have to pay 685. So we know that anywhere at 355 or above, we're just going to give away our premium. It doesn't matter if it goes to 355 or 1,355. 1,355. Still just, our risk is defined. Now we have to start making that money back once we get below. So if we go to 354, well, now my long puts are $1 in the money. They have extrinsic value. Strike price minus the price of the put. Exactly, Brad. So the put is worth $1. I have to pay $6.85 to have the position on. So I lose $5.85 until we get to, let's see, 340. 3. Jam it up here. $6.85 we paid for this thing, right? Yeah, so at 348 minus 6.85, that's what we paid. So at 348.15, then my puts are worth $6.85. I paid $6.85 to have the position on. That's my break-even price, and I'll put this back in the spreadsheet for you guys. It's not that hard of a calculation at all. And so the same thing goes for credit spreads or debit spreads. So if we have a 360, 365 call spread on, right? We have the 360, 365 call spread on. That's going to cost us. It's going to cost us $2.10. And we are long that and short that. So it's the same thing. We know that 360 and lower works the same way as a call. 360 and lower, we're just going to give back our 210. If we get to 360, 210, 360, 210, well, now my spread is worth $2.10 at expiration. Same thing. Well, now that's my break even because I've paid for that premium I've put out there. Okay? That's how we calculate the call spread break even. Put spread break even, same thing. If we do a 350, 355 put spread, long this and short this, and at 355, the put spread is going to cost us Sims 350, 355. Long this and short this, that's going to trade for about $1.80. So for $1.80, $1.80, Mike. So at so we know that anywhere above our strike, our initial strike, our long strike, we are going to be paying all of our premium. It's going to look like this at expiration. But as we move below the strike, we're going to start making money. So at 354, well, this is worth $1. I paid $1.80. So I'm only losing 80 cents and not $1.80. So if you get to 350, 320, well, now my put spread's worth $1.80. My premium paid is $1.80. That's my break even. Okay, does that sink in for everybody? Do we want to go through credit spreads, or do we want to let this sink in for a little bit? Where the break even is on a credit spread.
Door crack, so it's cooler back there. Right. And so when Raekwon came up, everybody was so me and my guys, we're like all 6 feet. So we were like,
anybody there?
Let's just stay here. And we were at the bar, you know, we just had the bar to ourselves. So.
Credit spread's going to have the same sort of feel, but different. So add premium to long side on debits. Well, no. In the case of a call spread, you add the premium to the long side, to the long strike. In the case of a put spread, you subtract the premium from the long strike because you make money as the underlying goes down in the case of a put spread. Like I said, I'll put this back in the spreadsheet. So you want to be able to think about it and then confirm with the spreadsheet. I understand you don't want to rely on the spreadsheet.
Everybody was like doing
Okay, do we want to let that sink in, or are you guys ready for credit spreads? Or do you want to take a little break and we'll do credit spreads? Not like we have a whole lot going on between now. Let's do that. We'll break this into credit spread and debit spread videos, and then if you're clear on one, you don't have to listen through the whole thing. Let's do that.
and like after you said that, I was